That way, for those of you maybe that need to drop off early or didn't get a chance to, want to rewind later on, we did get the permission from Dr. Ola that it's okay. And Tedla, of course, is also okay with that, and I have no problem with it. And then if you want to share it later on with other people, you're welcome to do that. So no problem at all. All right, get back to the deck here. All right, well, welcome everyone to today's conversation. So the topic here, we want to talk about venture capital in Africa, and we have none other than somebody that's been in the game for a very long time, very seasoned and experienced, Dr. Ola Brown, who will be having a conversation here with Tedla E as well, former Goldman Sachs. So, when we get to the introduction, we'll talk about some of that stuff. So we'll just, just dive right into the conversation here. So, the agenda for today is we'll just do a brief introduction on, who we are. For some of you that don't know, who I am or the programs that we run. Then, Tedla will have the chat with Dr. Ola Brown. And then we'll have an opportunity where people can ask questions. And then you can ask questions. We can unmute you through using your voice, or you're welcome to use the chat and then, type in your questions there. We also do have some people that did send in some questions ahead of time. We'll also, ask those. Hopefully we can all, learn from the session today. And then we'll just conclude, have some closing remarks, and then we go from there. All right, just admitting some people to in the lobby. All right, so we'll just start off. For those of you that don't know who I am, my name is Malik Khan. I am the founder of a company called Point Click Technologies, which we are an IT company based in the US. I am Gambian, born and raised in the Gambia. However, I went to the US at a very young age at 14 and kind of lived and grew up, in the US. But I've been in business for a while, over 20 years experience now, specifically focused on IT, cloud services, and just helping organizations with transformation. If you're looking to transform your business, leveraging technology, those are areas that we focus on. Back 5 years ago, we decided to venture into Africa. Of course, wanted to start at my home country in the Gambia. And we've done quite a bit of things there, including this Disruptive Lab, which is the first innovation hub that we started in the country. We think that it's really important as folks in the diaspora to, not wait for handouts from, I have nothing against the UN programs or the World Banks, the donors, organizations. But if we want to evolve, I think we need to, bring our knowledge, bring our funds, and try to, make something happen, through contribution. And that's what we've done over the years throughout. And just to kind of give a brief background on that, in the past 5 years, we launched the Disruptive Lab. The country did have semi-co-working spaces and semi-hubs, but nothing, full-fledged. So we took our own funds and built the first, real innovation hub, I would call it. I wouldn't say any more that we were the first, but we were the first real ones that mattered. And I think we still are. So not bragging here, but just facts. We've organized many events such as Who is Who in Tech, basically thinking that we should connect those in the diaspora in technology and those in the local community within the Gambia, and hoping to expand that within, the continent of Africa to do that as well. We've supported multiple local tech initiatives in the country, networking events. We launched an online YouTube channel called Disrupt TV. The link for that will be at the end of the presentation. And then we've invested in some local startups as well, just to kind of help boost the things that are going on within the ecosystem there. Today's session is brought to you by a program that we launched a year ago called Drill Series. And it's really designed to drive economic development through entrepreneurship, education, and digital transformation. Things that we've done, we've had experience doing it. And I thought, why can't we really build some programs for us, by us, and then contribute to the development of our nation? And then, we have a series of activities, including a drill growth accelerator, which we just completed our first cohort. That was actually sponsored and funded by Apri Labs through their partners. I'm sorry, guys, since I'm the only one allowing people here in the lobby. There are people still waiting here. Sorry about that.
Don't worry, man. You're the doorman at the hottest club at 6 o'clock in the afternoon.
No, normally you should be able to allow people in as well. Yeah, so, we have the growth accelerator that we just completed the first one, the distinguished guest speaker series, which actually this was contributed by Tedla, which is what this conversation is. So this is not going to be the first of its kind. By inviting people like Dr. Ola to have, these conversations. We have a series of these that are coming up soon. The whole goal is just to kind of help, educate and learn from each other through, training and learning initiatives. We have drill management training, and then we have also something we're working on called the Drill Angel and VC Fund to help fund startups. So we'll get right here to just introduce, Tedla. Tedla is my cousin. We actually met for the first time in 2012. I was in New York trying to pitch the NFL for a big hosting contract, which we still have the NFL as a company since then. So I went to visit him at Goldman Sachs. Just a quick story. So as he's walking me around, I think he hurt his foot at the time. He had a cast on. So when he was walking me out, I'm like, Tedla, what exactly do you do? Tedla just turns around, looks at me and said, I manage risk. And I was like, man, he said it was so cool. And I was saying to myself, like, I shouldn't be doing IT. I want to manage risk too. So we've been close ever since. And when he came back to the Gambia and, me too, we kind of, recently just put our heads together and see how we can really kind of work together with our respective experiences, and just see what we can do. Usually people talk about all the limitations that Africa has, but if we have experience and some, at least I wouldn't say we're experts, super experts, but let's just contribute what we can, and that is exactly what we are doing here. So Tedla will give you a little bit more of snippets of his background, but very knowledgeable guy, especially when it comes to finance, investments, venture capital. Truly a talented guy that I'm really happy to have here on the platform. And hopefully we can get a really good conversation out of today's session. And Dr. Ola,
I have a direct deposit coming. Thank you very much for that.
Yeah. So when Tedla told me about Dr. Ola, I was just super excited. We've never personally met, but I'm just really looking forward to meeting her. So, I didn't want to really try to go in and introduce her, but as you can see her bio, many of you probably on the call know about her. I was going to allow Tedla, since, they have, a lot of working relationships and personal from school. So Tedla, if you don't mind just maybe introducing Dr. Ola, but it's really a pleasure to have you on the platform. And thank you for taking time. I know you're traveling in the US. So, taking time out, we really, really appreciate your time. So thank you.
Thank you. I'm
Tedla.
really, really glad to be here.
Yeah. So Tedla, if you want to add more to that, please.
Yeah, sure. Do you have any other housekeeping items to hit? Because once I get into the intro of Ola, because we go way back. So so I wanted to kind of go from the introduction and straight into the conversation. So if there's any outstanding housekeeping items, let's hit it up front. Otherwise, we can go directly into the intro and chat.
No. So the next slide is just to start the session, and
Wonderful.
you're welcome to take it from here. So I'm just gonna go on mute and talk to you guys at the end. Thank you, everyone, again, and looking
Wonderful.
forward to the session.
Wonderful. Thanks, Malik. Thank you for that magnanimous introduction. Like I said, I have the direct deposit coming. Add it to my tab. But first of all, I want to kick off by welcoming everyone and joining this who are joining the session today. We were very, very fortunate to have a very robust registration list and attendee list here today. We have folks that are dialing in from across the globe. It is it's 6 o'clock p.m. GMT, but I recognize it is the middle of the day in various parts of the world. And if it is not the middle of the day, it is cocktail hour wherever you're at. So you're making a real sacrifice to be here. So thank you and welcome. Look, I am extremely excited about this particular session. First of all, just to piggyback on Malik said in terms of what this distinguished speaker series is, the idea behind this speaker series is really to democratize our Rolodexes and our knowledge, right? To people who are focused on impacting and investing in our beloved continent of Africa. And with that in mind, I honestly could not think of a better person to kick off this series than my dear friend, Dr. Ola Brown. Now, all protocol observed, because she has a lot of accolades and a lot of designations. So all protocol observed. But I want to, many of you know her from the incredible work that she's done, but I really want to introduce you to my friend. Ola and I have known each other since we were wet behind the ear, breast smelling like Similac in the wayward halls of Alcuin College in the University of York in the UK. At the time, I was a economics student trying to find my way, and she was a medical student. Now, the one thing that we had in common, despite our different academic pursuits, was we were two African kids that were really coming to the UK to study, to develop a skill set to impact where we came from. And for me, being of mixed heritage, Ethiopian, Gambian, born in New York, I remember when I first moved to the Gambia from New York, I really thought it was New York City with the beach. And then I had a rude awakening and realized that was not the case, right? And, one of the things that I quickly understood was that development, as my cousin Malik, mentioned in his opening remarks, development, signboard development or NGO-driven development really was not really going to get the job done, right? I'm going to date myself a little bit. I was coming of age in the early to mid 90s. And so you had the, East Asian growth explosion. You had the Eastern European growth explosion. And for me, the common denominator there for me was commerce and capital markets. And so for me, that really kind of honed in my academic pursuits. I'm like, all right, if I really want to have an impact on Africa, given that, we've already realized the political emancipation, on the continent. And if we really want to get economic emancipation, that was not going to be driven by organizations like the World Bank and United Nations. It was really going to be driven by dynamic business people and entrepreneurs and capital markets professionals like many of you on this call. And so that really led me on my academic pursuit and then subsequently my professional pursuit. Ola, likewise, saw the world and saw the world at a really micro and macro level at the same time. She saw in a very personal way what the realities of having a doctor to patient ratio of 1 to 10,000 meant in practical and personal terms. And I'll allow her to kind of expand on that, as we go through the conversation. And that kind of inspired her to be one of the pursue a career in medicine and being one of the distinguished inaugural graduates of the Whole York Medical School. And from that, she took her academic pursuits and practicalized it. She from there went and founded the Flying Doctors of Nigeria. That was basically an air ambulance service company that she's founded to solve a very direct problem. She had a family member, a sister, who unfortunately like so many of our loved ones, was disadvantaged by poor medical infrastructure. And she realized that, you know, a life could have been saved by just having an air ambulance service to be able to promptly evacuate, you know, people that need emergency healthcare. And she basically founded a company to solve that problem. That problem not only solved her own, but so many others. That was very successful, and basically grew in her impact, in her purpose, from going from operator, business operator, to angel investor, to now prolific, not only venture capitalist, but also one of the leading economic minds in Nigeria and in West Africa. So for me, when you see a colleague, someone that you pretty much grew up with from university, achieve such heights at a very young age, you realize that it's not just talent that is catalyzing that, but it's purpose, right? And I really want to underscore that purpose point, because so many of us, or so many people outside of this call, are attracted to the idea of being an entrepreneur or an investor because it is the it thing to do. Like 10, 15 years ago, it was the it thing to do to go onto Wall Street because you can make some money. But a lot of times the it thing to do does not necessarily align with purpose. It doesn't necessarily, therefore, align with impact. And the thing that remarked me the most and impressed me the most about Ola from when we met back in Alcuin to this day is how remarkably she's been able to align herself with her purpose, and align that with not only just creating wealth for herself and creating impact within her nuclear environment, but really creating impact within her country and across the continent. And, you know, as we think about the venture space in Africa, you kind of look at it, if you look at the ecosystem, you crudely have the entrepreneurs, then you have the what I'll refer to as the mom and pop investors, which are, you know, the angels. Then you have the quasi institutional guys, which are the syndicates, and then you have the venture capitalists. And Dr. Ola Brown has pretty much lived every single life. And I think with each of these life experiences, she has a lot to offer this audience. As I said at the top of the introduction, we have a very robust group of folks dialed into this session. Largely, the majority of the participant groups are entrepreneurs. Startup entrepreneurs, majority of them tech-enabled businesses. We do have some buy-siders sprinkled in here, as well as some policymakers, and government officials. So I think we all have a lot to glean and learn from Dr. Ola Brown during this session. So with that, I'd like to turn it over to Ola and have her say hello. And then I would like to kind of start the conversation from the beginning, right? So we can kind of follow that journey and elucidate the lessons as we go across. Now, this session was designed to be interactive. So we are going to have a moderated Q&A between me and my good friend, Dr. Ola Brown, for about, 30 minutes or so. But very, very quickly, I want to really kind of turn this over to you, the audience, and have you be able to pick the brain of one of Africa's finest. We joke amongst our friends and said, Ola, since university, has been collecting degrees and accolades like Thanos in Infinity Stones, from becoming the, one of a young global leader from the World Economic Forum, to every single Forbes list, to most recently and most notably being conferred the national honor of member of the Order of the Federal Republic of Nigeria, and being probably one of the youngest, if not the youngest person to achieve such a standing. in one of our great nations on the continent. So Ola, I'll turn it over to you. Say hi to the peoples, and we can kick this thing off.
Hi, and thank you, Tedla, for that really heartfelt introduction. Because I moved to Nigeria sort of about 10 years ago, my history with like practically everybody I know is 10 years. So I don't know, I hardly interact with anybody that has known me longer than that, because, you know, when you change countries or you move, having never lived in Nigeria before, it's really rare to actually meet somebody that could tell a story before I started my company. So it was just really emotive listening to you and, you know, thinking about all those university days. You left me in university because unfortunately when you study medicine, you spend a lot longer in university. So I was there for 5 years. Lord. But really, really great. Thank you for that introduction. And hi, everybody. Looking forward to a great conversation. Really hope that I'll be able to share my experiences with you and also learn from you as the conversation progresses.
No, ignore that. This is Africa, baby. Like, no matter how much you try to like plan this stuff, there's always random wahala going on in the background. So I beg, forgive me for that.
So I was just saying that I'm looking forward to the conversation and looking forward to sharing and also learning from the audience.
Fantastic. So let's start off from the beginning, right? So when you joined York, pursued a degree in medicine, and immediately, in literally relatively short order, yes, you did your your mandatory service with the NHS, et cetera, but you very quickly bore the hat of an entrepreneur and started your first company. Walk us through what made you do that and the process that it took for a young, dynamic, but a young female entrepreneur on the continent. And I underscore all of these things because unfortunately our dear countries are not as progressive as we may like. But and these are hurdles that you overcame. Walk me through what motivated you to start the company and some of the challenges that you face. Now, recognizing we have entrepreneurs here, African entrepreneurs, and so everybody wants to know, how do you fund your business? How do you basically bootstrap? So let's kind of talk as tactically as possible as we walk through your journey.
Okay, all right, perfect. So I was working in the NHS, but I wasn't happy because I felt like I could only treat one patient at a time. And I just didn't realize how involved being a doctor is. Like, I felt like there were so many sick people, particularly in Africa, yet I was spending 2 or 3 hours with a patient. And I'm like, how do I, you know, expedite that impact? How do I have exponential impacts? Because right now, I feel like it's only the patient in front of me. There's only so much I can do. And also the NHS, I felt also that I was a big part of a very big machine. I mean, the NHS is the largest employer in Europe. It's the 6th largest employer in the world, bigger than a lot of countries. So in terms of the impact that I was making as a person on the healthcare system, I knew that I was a part of it, but I didn't feel like, you know, I was having the level of impact that I wanted. So I started thinking what else I could do. I was taking flying lessons at the time because I liked aviation. And I also thought back to what happened with my sister. This happened in my 2nd, 3rd year of medical school, where I unfortunately lost a sister due to lack of emergency care in Nigeria. So that was always on my mind. Just thinking, you know, how could this be avoided? How is it that there's so many resources in the UK and yet even the simple things that are available so easily in the NHS, I wasn't able to get in Nigeria. And I also thought about Pan-African impacts, like how could I turbocharge the impact that I was having? So I made quite a snap decision to move. I'd saved some of my salary, so I lived in a much smaller house than I could have. I was very frugal during my first year of work. And I decided that it was really time for me to do something in Nigeria. And since I had sort of a background in aviation and a background in medicine, and a passion for emergency medicine, I thought, one of the more interesting things that I could do was perhaps combine those two passions to make impact in healthcare. So I moved to Nigeria, but I didn't really know anything about finance. And I think one of the first lessons I learned the very hard way is that there's a big difference between being an expert in something and being an expert in the business of the thing. So I was a very good observer. I'd read all the textbooks, I'd taken all the exams, but I couldn't read a balance sheet. So when I speak to entrepreneurs now, I think there's a big difference between what you're passionate about and what you feel you're very good at as an expert, maybe in an academic way, and maybe an area that you've got a lot of work experience in, but that's completely different from the area that's the business of what you do. So I'm sure we've all seen it with hairdressers, for instance, who are very good at styling hair, but when they open their own salons, it's terrible. Or people like to bake, or people like to cook, that go on and start a restaurant, and then it's a complete disaster, because these are two very, very different things. So that was the first challenge, really dropping my ego as because throughout your career as a medical going into medical school, people say, oh, you're so smart, you should study medicine. And then when you're in medical school, even at university, they're like, oh, you say you're a medical student. I say, oh, you're so smart, you must be smart. And then you get into a business and realize that you're not that smart at all. And actually there's people that
I like that.
Yeah, so that's a lesson that I'd like to share.
I like that. Let's just pause there for a second, because I think you hit on a couple of really, really important things, right? Number one, that really resonated with me, and I think it resonated with a lot of people on this call, was the first step of leaving your cushy linear career path, right, with the NHS, right, secure, right, career path with the NHS, to move to Nigeria to start your own business, right? And that is a decision that I believe a lot of people on this call have made to kickstart their entrepreneurial journey, and it's not one for the faint of heart, right? And I want to kind of double back to that in a second, but the second point that you made there, which really, really, really resonated with me, is the point of knowing the difference between having a good product and having a business, right? Because your passion and your skill set can lead to a good product, but it may not necessarily lead to a good business, right? And understanding the fundamentals of business is tantamount to success. It's critical, right? In Wolof, we say, I always joke and say, fine, numbers don't have sutura. Sutura means, I'm going to bastardize this, so all the Gambian and Senegalese people on the call, please forgive me. But what it means is effectively is grace, right? Numbers don't have grace. And what I always say is understand your numbers because they're telling a story. And if you're not telling the same story that your numbers are telling, right, it is going to come to bite you in the butt, right? And the fact that you took the time to invest in graduating your good product and your hobby into a great business so early on is remarkable. And I really kind of want to underscore that for everybody on the audience. Anybody who knows me knows that I really, really, really drive into this point with entrepreneurs, but I think that's something to really underscore. Let me ask you this. Like, when you started your business and you're bootstrapping your business and you have negligible runway, right? Because you're bootstrapping it. How do you think about the day-to-day operations, right, and growth?
Absolutely. I still think that bootstrapping is a great way to start a business. I think that it teaches you discipline early on, and you don't get too familiar with words like runway, for instance, because you don't have a runway. Everything that you earn is collected from customers. And there's a great course. It's on Coursera, but also on YouTube by a professor at the University of, no, London Business School. He's called Professor John Mullins, and his whole book and his whole sort of professional career now is dedicated to customer-funded businesses, so effectively bootstrapped businesses. And that was my business for the first few years, for the first 4 or 5 years, until we had several $1 million in revenue. Every single penny came from customers. And what that does is it protects you from your ego, because in terms of operations, you realize that you really have to make a product that people want to buy. And when I see like a lot of tech companies that have raised capital, I think that they can get quite careless because it becomes a valuation game, and it becomes, they can become quite wasteful. But when you're bootstrapping, you learn how to run a business in a really disciplined way. And that means that you're keeping a lid on costs, personnel costs, for instance, personal costs. And when we came to raising capital as a management team coming from that discipline, I think that we're able to much better navigate it and use the resources given to us really judiciously to build on that growth. Because we'd started as a really frugal, scrappy team that had to get money from customers. So we were a customer business for sort of the initial stage of our business, and that meant, pitching to some of the companies, etc., and getting contracts out.
I love the fact that you made that point, and it's probably foreshadowing a little forward in the conversation. We kind of think about how, wearing your VC hat, how you basically assess prospective portfolio companies and investments. But I guess, just to kind of go there a little bit, is that something that you yourself as a VC look for in prospective portfolio companies? Do you look for that scrappy bootstrapping beginning, or do you, if you have a founder who's fortunate enough to have one of those blockbuster super seeds, if they're falling out of a name brand company or et cetera, do you look at that slightly differently, particularly in the African context?
So when we're looking at founders, we always look for grit. We always look for an ability. What have they done with the resources that they've been given? So whether it's a blockbuster company or whether it's a small company, we look at how much has gone in and how much they've managed to get out of the capital that they've raised. Sometimes we're the first check-in. And if we're the first check-in, we're always looking at, okay, they've raised money from their friends, they've raised money from their savings, and how scrappy have they been? How much grit have they put into the business? And how has that sort of demonstrated itself? And I've just put a link in the chat to my whole venture capital course. It's 8 hours, so it's not going to be possible to cover everything in this discussion. But just to say, yeah, definitely that's something that we look for, probably the biggest indicator for us. We've had investments that have failed, and those investments have been more or less the founders that raised too much. They were overfunded, actually. So we like our founders to try and be like those scrappy founders that are really efficient with capital and really look at unit economics and margins and fundamentals quite early on.
I love that. Doubling back into your particular journey, right? We went from the beginning to millions of dollars in revenue. Walk me through like some of the key milestones, at least you as an entrepreneur, where you're like, thank you God we got to this point. Like, what were those milestones for you? And then walk me through your mindset as you start to think through raising outside capital?
So I think the major milestones for me were realizing that this was a repeatable business. And that came within sort of the first 2 years, realizing the demand, realizing the size of the market, and realizing that it wasn't just going to be a passion project, that this was a good margin business. And that it could continue to grow sort of exponentially over the years. I think there are a lot of doubts, like, would this work in Africa? Does it only work in Kenya and South Africa? Because there was no large air ambulance service in West Africa. So I think it's realizing that, you know, this was a repeatable business, and you need a bit of data.
And how long did it take you to get there?
Probably 2.5 years, when I started to realize, okay, we've done 1 year, it's grown the second year. The margins in this business are good. This is something that we can continue to repeat. This is something that I can train a team to do. It took sort of 2 years to get to the point where I knew it was a business and I knew that I wasn't going back to the UK. Then probably another 3 years to sort of realize that, okay, this is going to be something that we can build to sell.
I like that particular point, build to sell. Now, a lot of times when founders, particularly when they're courting institutional capital, they're always confronted with the idea. There's kind of two schools of thought, right? You know, the one school of thought is the classic, show me what your exit opportunity is, because you have obviously structural limitations on the buy side, and funds are always kind of thinking about their exit, right? And then you have, on the other side, you have investors that want to see founders that are mission committed, right, and aren't looking for the exit. As you kind of look back when you were starting your particular company, what was your particular mindset? And as you kind of evolved in your business, how did your thinking evolve, if it did?
Okay, so for us, because we didn't take external capital early, there was no real pressure to exit. And I think that people need to really think about this, particularly at the early stages of their businesses. I did a tweet, I think yesterday, where I said, you know, there's plenty of businesses in Africa that turn a profit, give a dividend to their shareholders, and they do that consistently year on year. And for an investor, that can give you the same kind of financial outcome as a VC investment, and you get liquidity every year. So for example, if you have like a 40-30% dividend payout ratio, then it can end up for an investor over 10 years getting a 10x investment or return on their investment without even having to sell the company. So I think it's really crucial for people to think early on whether the business is venture backable in the first place. So whether you're going to get to that sort of $100 million, $50 million revenue level where you can have like a large exit, because what VCs are really looking for is not a 1x or a 2x return. They're looking to sell within 7 years at a level where they can get 10 times their money back. And that means that you're putting yourself in a situation where you're on a treadmill. So you raise your seed, you raise your Series A, you raise your Series B, and you're giving away more and more of the company as you do that. And only certain businesses are suitable for that. Some businesses might just take money from a few angels and be profitable businesses and give dividends back to shareholders as and when due. So I think it's important, and it doesn't make you less ambitious because it's a business that's just profitable and paying dividends to shareholders. That doesn't make it less ambitious. It doesn't mean that it's less likely to become a multi-million-dollar or even billion-dollar business. But I think it's important to decide sort of what lifestyle you want to live as an entrepreneur, whether you want to be a VC-backed company, whether you want to be more like an angel-backed company, or whether you want to go the debt route and grow with bank debt.
That's actually really interesting. Do you mind just elaborating on that a little bit? Because I think that's a really, really good point for our audience here to understand the different complexions of businesses based on the funding that they receive or basically embark upon on their journey, right? You have like your VC backed, you have your angel backed, and you have your debt backed businesses. Do you mind just expounding upon each of those profiles a little bit for the benefit of our audience?
Absolutely. So in terms of venture, I'll just talk about that first. I have my course there on venture capital, but just in terms of my background, I've invested in 30 companies. The total value of the companies in our portfolio is nearly $1 billion. 50% of those are female founded, and I'm quite proud of that. We've created 1,000 jobs in 10 African countries. And the total number of users, both patients for our health tech arm and users for our fintech arm, are nearly 1 million users across the continent. So that's stuff that we're super excited about. And our portfolio companies have raised almost $100 million in follow-on capital since we've invested. So we're a venture firm and we like venture backable businesses. But obviously, when I'm speaking to entrepreneurs that want to raise venture capital has its advantages in that it allows you for a temporary period of time to sort of cheat capitalism. Before venture capital, you really needed to have a track record of profits, good margins. You needed to have built some kind of solid business before a private equity firm or a bank would give you additional funding. But in venture capital, you really need to have an idea or a vague sort of product market fit and some traction, and you can attract a lot of funding. But obviously, because we're cheating capitalism, that comes with some downsides as well. So the fact is, you're giving out a proportion of your company at a very early stage, and once you have VC in your business, then you're expected to continue to raise more and more capital. So a VC wouldn't be happy if you just decided to raise one round. You're expected to raise your pre-seed, and then a year later your seed, and then maybe 2 years later your Series A, and you're putting yourself on that treadmill. And that person wants you to sell your business. So it's not like our dad's businesses that were family businesses. You have to sell the business. That's how the VCs make money. There's going to be an exit. And the VCs will begin to force that exit once they own 30 to 40% of the company, which they often do by Series A. And I discuss this a bit more in my new book, Journey to Series A. So if you're following me on Twitter, the book will be available free of charge next month, where I talk about this big Series A round where, people will start pushing you to sell your company. And, that's something that you've got to think about. I mean, if you think about Twitter, for example, by the time Jack Dorsey had done all his fundraising, he owned like 3% of the company. So that's the nature of venture capital. You need to be aiming for exponential growth. You're continually under pressure. You have a lot of reporting requirements. So the VCs will want, your annual reports, your quarterly reports, your monthly management accounts. Some of them will want that in real time, especially post Series A. So they want to see every transaction you do in real time. So not even waiting for the end of the quarter, but actually having access to your account. So it's quite an intrusive process. But the upside is that you get to cheat capitalism for a short period of time. In terms of an angel-backed business, these stakeholders are usually not as aggressive as VCs. So honestly, a typical angel, depending on the type of angel, but a typical angel investor may not be pushing you to an exit. They might say, if you have a conversation with them, their business model might be different and they might be happy for you to turn a profit. They earn a small share of the profit. And you split a dividend at the end of the year. So let's say you make $10 million of profit in a year, and your dividend payout ratio is 30%. So that means that $3 million out of your $10 million of profit goes to shareholders, goes to yourself, and goes to other shareholders. And that happens every year. And the company doesn't really need to grow. It can stay like that for 15 years. You don't really need to sell. You don't need to IPO. Some angels are just happy with the more dividend-based model, with a nice, profitable company that just spits out cash every year. And they might offer some governance. They might have a board seat, but I'm not sure that they'll be pushing you to sell your company, or some of them won't be pushing you to sell your company as aggressively as a VC, where you have to sell the company. That's the whole aim. And then when you're doing a debt-backed venture, the banks don't care at all. In fact, for a bank, you can take that money and put it in US treasuries and not do the business at all, and then give their money back in local currency. As long as you give their money back, they don't have a care in the world about where that money is coming from. It doesn't have to come from the business. They don't need a board seat. They don't need to see your accounts in real time. They're not going to tell you how to run the business in any way, shape, or form. All they want is their money back as at when due with their interest. And if you can't produce the money when due, then they might seize your father's property, depending on what you used as a collateral. If you used your father's property as a collateral, then they'll seize it if you can't pay back. So those are sort of the archetypes of investors. Obviously, some angels are more VC orientated, but a lot of them aren't. A lot of them just want to make investments in companies that they understand, in industries that they understand, and just have a normal, profitable company and just see how it goes. So that's sort of the three archetypes that I talked about in a bit more detail. Sorry, I've lost you. I think you're still on mute.
Sorry, I apologize. So I think that's fantastic. Thank you so much for elaborating that, because I think it's very instructive for a lot of the entrepreneurs on the line to understand the different, not only investor archetypes, but also the practical consequences of taking that type of capital, right? And everybody likes to kind of keep up with the Joneses, and people think that it's very easy to feel like you don't have a successful business unless you're raising venture capital. That's not the case, right? So it's really important for you to basically right size your business to not only your capital needs, but also to your asset allocators, so your investors, right? And that alignment between investor, business, and outcome is absolutely critical. And it starts with you, the founder. And I really appreciate you. I really appreciate you basically walking through those different archetypes. Now, let's kind of go through kind of using your life as a loose case study here, right? Now, you basically reached a point of actualization within your business where you felt you had capacity to expand your impact, right? That's one of the things that you constantly speak on, not only in this session, but in general. I see that you expanded your reach and your impact by starting to invest in others, right? And empower and incapacitate others. And you did so, to me, correct me if I'm wrong, as an angel, and you kind of graduated up the ranks, right? To syndicate, to full-blown institutional investor. I think two questions here. One, when did you feel it was the right time for you as an owner operator to divert your attention and some of your resources into the investing realm, right? Because kind of going back to some of the earlier remarks, particularly in the startup stage of your business, a lot of times the investors, yes, they believe in the business. Yes, they believe in, whatever the market opportunity that you're presenting to them. But ultimately, it really ties down to the management team, right? They're backing the horse. They're backing the jockey, right? And so a lot of times when you tend to see founders divert their attention prematurely, either in overzealous growth, expanding beyond their core businesses, or going into the investment realm, right? You seem to make that judgment call pretty good. What were the key factors that influenced your decision to say, yes, Flying Doctors is doing very well. I have the bandwidth and the capacity to pivot, and that was okay to your respective stakeholders? And how do you basically take that mindset and reflect upon, prospective portfolio companies and founders that you're investing in?
Okay, so I didn't really pivot per se. I got an opportunity to be an LP in a fund. So we raised the fund, and I was just going to be a director and continue running my company. But unfortunately, my partner in that fund had an emergency and had to move to the UK. And then I was stuck with the choice to sort of, let the funds fail or run it. So at that time, my company was actually running really well. And honestly, like I'd stopped adding value because we had such a great management team. And in fact, the management team were probably better at running it than I was. So I think that there's a degree of self-awareness that I developed where I feel like I'm the kind of person that starts things, but my skills at basic managerial day-to-day tasks actually aren't as strong as the team. So since we had this funds pending with nobody to run it, and I had a very successful company, and I had invested the company's money in the fund, as part of our treasury, I felt a sense of duty to the investors in the funds and also to my own company to run the fund. So that's what I did. That fund did a 25% IRR and sort of changed my trajectory in terms of financial services and what I wanted to do sort of for the foreseeable future. But in terms of how does it inform how does my experience as an operator relate to my experience as an investor? I think they are two separate things. And I don't necessarily I think there are some transferable skills, but for entrepreneurs that transition to investment, I do think that there's some skills that aren't that transferable. Being in the business of finance means you need to be an expert in finance, and not an expert in entrepreneurship, but an expert in the way money works, understanding portfolio construction, understanding deeply financial modeling. So I think in terms of practical advice that I can give founders, they love it when I sit on their board because I can make those introductions. I'm good at business development. I'm good at putting sales strategies together, marketing. I'm good at hiring. And those are things that like a typical sort of investor, maybe from an investment banking background, may not have, but if they haven't run a business. But in terms of the core skills of putting a portfolio together, I think it's actually quite difficult for a core entrepreneur to walk into a financial services job, thinking that the entrepreneurship skills are all that are required. I think it's really important for operators to also understand really, really thoroughly corporate finance, and you don't get that depth as an entrepreneur.
I love that. I love that. One of the things that, just kind of pulling on that thread a little bit, when you kind of think about the skills needed for a successful investor versus a successful entrepreneur, just kind of focusing on the entrepreneurial side. One of the things that I love about you is like you're very quick to call out the bullshit, right? And understanding the importance of constructing the right management team, right? And in the wake of, Silicon Valley Bank and the dearth of CFO capacity and risk management, as my cousin started at the beginning of my introduction saying I manage risk, that's goddamn right. That's what every entrepreneur and investor is supposed to do, is manage risk. Do you mind just kind of expounding on the key things that you're looking for in a management team, be it in a CFO or a founder or the cadre, the complexion of it all, right? Because I think this is really, really important, particularly for early stage companies, in terms of when they're starting to think of building your team. It's not just the homies that are coming along, right? You need to basically present the best front, not only basically a best front to raise capital or for the showcase, but really the best front for the skill sets required to run and operate your business. And I think you really do a really good job of breaking that down. Do you mind just sharing with the audience what that is, at least in your opinion?
Absolutely. So I think that this is one of the most misunderstood areas around startups, which is the management team and hiring. And a lot of people, when they want to start a company, they want the biggest names that they can get in their company, because they think that somebody from Google or somebody from Microsoft or somebody from Goldman Sachs or somebody from McKinsey would have skills that could translate into a startup. And sometimes that works, but very often it doesn't work. I think what you're looking for in the earlier stages of your business is scrappy generalists. I can remember speaking to somebody yesterday, and she started a startup, and she spent most of the money that she'd raised in hiring sort of a hotshot engineer from Google. And the guy from Google had spent the past 10 years working on Gmail. Not any other product, just Gmail. Gmail is not a great product. Like, there's not that much work to do on Gmail. And it's the same product over and over again. And he was part of a 100-person team that was working on Gmail for 10 years. So you wake up in the morning and you check Gmail and it's okay. So then you wander around the office and then you talk to people and then you go back and check Gmail and it's still working because you've been working on this one product for 10 years. And it was a disaster. And, you know, she had nearly run out of funding before she realized that in the fast-paced environment of a startup where they're shipping sort of 3 or 4 new products a month and it's highly experimental, and there's no systems and processes, big company people are actually really, really sometimes quite bad for that environment. Yeah. It's about having generalists. And even when you're talking about hiring a CFO, for example, in a big company, the CFO sits on top of an FP&A team of like 20 people and a treasury team of another 20 people. And then maybe a tax team of 50 people. And then probably an accounts receivable team of 20 people. So the CFO is kind of managing this team of, you know, specialists and super specialized experts in all these different areas. And maybe does not have the skill set to do everything themselves, which you would be doing in a small business or a startup. As a CFO of a startup, you are the FP&A, you are the tax guy, you are the accounts receivable guy, you're the accounts payable guy, and maybe you have an intern or 2 other people doing it. But depending on how much funding you've been able to raise and how much in customer receipts you're getting, you have to be more of a generalist. So my advice to entrepreneurs in the startup stage is look for really scrappy generalists, because if you are exclusively hiring from big companies, you will get, number one, big company people cost a lot. Number 2, they don't really have the skill sets that you need in a startup. So you have to be very careful about onboarding them if you do want them to come into your company. And number 3, they come with a lot of politics. In a startup, people need to speak in a very straightforward way to each other because, you know, there's many fires going on and that need to be put out at the same time. Whereas in a big company, you do need to be quite political. 80% of your job in a big company is managing the politics. But in a startup, you don't really have time for that. You need to be able to communicate directly. And what big company people do is they also bring a lot of politics into the company, which a startup cannot afford. So I think for entrepreneurs thinking about making their first hires, look for really frugal generalists, look for people that don't feel above the startup that they're working for, and try and look for people with a long-term perspective who are more interested in equity than salary, and are willing to bet on the company with employee stock options.
I love that. I love that. Alignment is key, right? Because a lot of times when people kind of Google pitch decks of your favorite startup company, right? Like a lot of times, like the management company is littered with very, very fancy logos of places like Google and Facebook and Goldman and McKinsey, et cetera, even though Goldman people are pretty cool, but, you know, but at the end of the day, that's not what you necessarily need to succeed, right? And I think that's a message that really, 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 really should resonate for this particular audience, because as entrepreneurs, particularly in the African space, your management team may not necessarily be McKinsey, Goldman, you know, Google, et cetera, right? But they are those scrappy generalists, right? And there is power in that story, right? And that's where a lot of value is, right? So for the entrepreneurs on the line, really kind of, I really kind of want you to dial in and kind of reassess and mark to market your team, and use some of the guidance that Ola gave to kind of think about new hires, et cetera, and how you're kind of formulating your team. Because at the end of the day, these are the guys that are going to be the foxhole with you. It's not just the people that are going to look good in a presentation. It's the people that are going to basically help you build and grow that business. And you want those people to be aligned with you, that are not looking to clip a coupon as far as a salary, but are aligned with you in terms of deferring comp and being more equity oriented. I think that's absolutely fantastic. Let me ask you this, just piggybacking off that particular point, right? On management team construction and appeal from an investor perspective, right? There is the typical, there's a school of thought that say single founder businesses are high risk investment, right? For all the various reasons which we can go into, right? And so therefore, as a startup company, right, you'd be best served to have a multi-founder business. But at the same time, and you literally wrote the book on this, right? One of the key reasons why some businesses fail is division between the co-founders, right? And so I guess with that question, piggybacking off management team construction, both from an operational and from a fundraising and optics perspective, I guess both from an operator and an investor perspective, what's your thoughts on single founder businesses? Or do you subscribe to the idea that they're higher risk than multi-founder businesses, or do you have a different take on that altogether?
Okay, so most VCs want to see a co-founder. So if you're thinking about raising institutional capital with no track record, then you should probably get a co-founder. Once you're making millions of dollars with good margins, nobody cares. Because at the end of the day, the most important thing you can do in terms of raising capital is just have strong fundamentals. Once you're making great revenues, great traction, strong margins, good unit economics in a big market, nobody cares. But if you're not doing that, then they start looking at the other things. So your track record and your fundamentals are the most important thing that you can possibly have going for you when you're raising capital. And then it doesn't matter. But I would say that, yeah, for most VCs, they do want to see a co-founder if you don't have strong fundamentals, if the business isn't killing it, if you've got nothing to show, then, you know, you're relying on, you're at the mercy of VC preferences. But for me, I've never really worried about that. I look at the business because at the end of the day, I've invested in a company that had 3 co-founders and all of them resigned. And it was actually a member of management that stepped up and started to run the company. So it was just one of the managers, one of the editing team that stepped up and started to run the company. So, you know, the chances are that if the company falls into challenges, that both of the founders will leave anyway. So I've not seen it in my personal experience being a huge factor. Rather, I like to look at the fundamentals of the business because no founder leaves if the business is doing well. They only leave if the business isn't paying their bills.
Fantastic. Now, kind of like going slightly bigger picture here, right? You know, in terms of your investment focus, your portfolio is built up of healthcare related companies, health tech companies, fintech companies. Walk us through how you kind of landed on that investment thesis. Was it just basically a natural extension of your skill set and your expertise? Was there a market driven dynamic to that? That's one. And then 2, recognizing I'm sitting in the Gambia, right? I'd be remiss to say in life in general, but particularly when it comes to capital, there's a world of the haves and the have-nots, right? You know, Europe and the United States and Asia are the world of the haves relative to the Africa have-nots, and the Nigerias, Kenyas, Morocco's, South Africa's, Egypt's, etc., are the worlds of the has relative to the Gambias, which are the worlds of have-nots, right? So I say that to kind of frame the following sets of questions here, right? One, in terms of your investment thesis and what you guys are allocating capital on into, what led you to healthcare and fintech, and then two, I'd love to kind of get your sense of your broader macro read, right? In terms of where you see the opportunities being, particularly in the framework of the world of the haves and the have-nots.
Understood. So I'll start with the reasons why health tech and fintech. Number one, they're massive markets. 1 in 5 unicorns in the history of creating unicorns is a fintech company. And the third biggest unicorn creating sector is healthcare. So these are two big mega markets that you are underserved in Africa in so many different ways. Africa has the worst healthcare outcomes in the world. You're more likely to die in a car accident in Africa, 7 times more likely to die in a car accident in Africa than in Europe, for instance, twice as likely to die after a surgical procedure as a result of complications compared to if you had that surgery in Europe. More mothers die in the process of pregnancy and childbirth than anywhere else in the world in Africa. And when you look at fintech, there's the largest number of unbanked and underbanked people in the world without access to credit, without ability to save, without ability for people to own their own homes, without ability to pay and get paid. These problems keep people in poverty. And I think, from our mindset, I can remember Malik at the beginning talking about charities. Charities deal in the business of poverty alleviation, whereas entrepreneurs deal in the process, and entrepreneurs and investors are in the business of prosperity creation. And I think that poverty alleviation isn't really our goal. When we're looking at big problems to solve, we're looking at how to create prosperity. China was able to lift 1 billion people out of poverty, and I think investing in these two sectors will be able to do the same for Africa. The second reason, beyond the numbers and beyond the impact, is also around deep subject matter expertise. I think that if you have a very, very deep level of expertise in a particular area that you're investing in, then that brings about a competitive advantage compared to generalists. If you look at the statistics for specialist funds versus generalist funds, you find out that specialist funds kind of outperform, from most studies that I've seen, outperform generalist funds. And I ran a generalist fund before, and it was really difficult for me to know as much about agriculture as I knew about B2B SaaS, as I knew about logistics, as I knew about sorts of climate tech. Whereas just keeping it really narrow means that we can, and the team as well. I mean, almost everybody in our team either has a background in medicine or healthcare or banking. It helps us really add unique value in ways that perhaps people that are sort of broader can't add. Mm-hmm. So there's the financial sort of reasons in terms of these are massive markets and they're unicorn factories, these two sectors. Mm-hmm. Number two, that's the impact. The big problems with poverty, the big problems with maternal mortality, the big problems with child mortality. And then there's number three, the fact that, deep subject matter expertise can and often does, according to the evidence, lead to superior outcomes. My background in medicine, I also worked in Japan in lab science, studying stem cells, and then obviously went on to do a master's in finance and economics, invested in a lot of fintechs in our first fund, including Paystack, which was sort of resulted in one of the biggest exits on the continent, invested in Flutterwave, for instance. So got really granular with fintech businesses. Now I'm doing my doctorate in finance as well. So I think that deep subject matter expertise is something that really gives a competitive advantage to any investor, just understanding quite deeply what these sectors are, what businesses can be built in these sectors, and having huge networks that our founders can leverage on.
I love that. So on the operational side, scrappy generalists. On the investor side, narrow specialists. Fantastic. I love that. And I think that's a really good segue into some of the audience Q&A. I promise this is going to be as interactive and dynamic as possible. We have some fantastic questions coming in from the audience. Just to kind of lead into that, being a venture capitalist in one of the ivory towers of the continent, so to speak, right, in the world of the haves from a capital allocation perspective, right? How do you look at how do you as an investor and other investors of your ilk look at ventures in non-target markets as not just ventures in potential investment opportunities in non-target markets, but also interacting with the local buy-side community in said markets?
So how do we, in non-target markets?
Yeah, so non-target markets, so like the non-glamour markets, so not Nigeria, not Ghana, not South Africa, et cetera, right? Cool. Like, so if you're looking at Gabon, Gambia, you know, et cetera, right? I'm going to say Gambia. I'm going to stand on Gambia because I'm Gambian. Looking at a market like the Gambia, for example, right, which is a population of 2 million people, which is a neighborhood in Nigeria, right? Like, how do institutional investors like yourself, right, assess prospective investment opportunities in non-target markets like the Gambia, and how do you basically look at interacting with the local buy-side communities in said markets? Okay. As part of your investment process.
So Africa is dominated by the big four markets of Nigeria, Kenya, Egypt, and South Africa. I think it's 70% of all venture capital, probably closer to 80%, goes into those big four markets. They also account for almost 50% of African GDP and consumer spending. And most of the M&As, this is a real thing that attracts venture capital to those markets. I think it's 90% of the M&A activity, that's the exit activity, occurs in the big four markets. And of course, they also coincidentally also have the biggest stock exchanges in Africa, meaning that, you know, there's exit opportunities potentially on the public stock markets as well. So that's the reason why there's a big four bias with VC, but that's changing. And when we are looking at companies outside the big four, we're looking at what's their competitive advantage, what kind of traction do they have, what kind of business model. So sometimes the business model could be to serve customers that aren't in the country. So for example, a company in Gambia that actually provides remote working services for Europe, for instance, and the company is just based in Gambia, the team is based in Gambia, but actually it facilitates work for consumers or has designed software for consumers in Italy or Spain or Germany. That would be a super interesting business model because the team is based in Gambia, but they have a software product with 70% margins that they're selling over and over again in Europe. That would be a super interesting business model because it doesn't rely on the consumer market or the consumer spending within Gambia. So we look at the same kind of things in non-big four markets that we look at in big four markets. But the population and the total addressable market is something that we really, really scrutinize, unless, of course, the company is, you know, just based in that country and is really selling into America or selling into Europe or selling into the rest of Africa.
That's fantastic, and I'm really, really happy that you made that particular point, right? Because I think that this is one of the things I believe Malik and his team at the Drill series have done an incredible job with his particular cohort, is really kind of challenging his cohort participants to evaluate their total addressable market. Right. And I think that one of the advantages that non-big four markets have is the cost arbitrage that they tend to have relative to big four markets. Right. And if you are in a non-big four market and you have a business that has the potential to scale into a big four market, leveraging and capitalizing on the cost arbitrages, and the what I'll refer to the cheap learning experiences, the cheap at-bats, right, that you naturally need as a startup entrepreneur to get things right, it's cheaper to operate in a market like the Gambia than somewhere like Nigeria. So if you're thinking dynamically about your particular business, you're not limited by your geographical boundaries, as Dr. Ola mentioned, right? You can really kind of think dynamically and robustly around your total addressable market, and that really matters depending upon, again, the type of business that you are trying to build, right? If you're trying to basically build a VC-backed business that goes through that traditional path, understand that you have to kind of think about maximizing total addressable market and thinking along those lines. If you're thinking about, if you're going to opt for a angel-backed or debt-backed business that really is really reliant upon profitability and cash flow, right, and not necessarily maximizing exit opportunities, you're not looking at 10x, 20x, et cetera type of multiples, that's fine, right? So it's really important to know oneself, know one's business, and plan accordingly. And I think you did a fantastic job of elucidating that. Just pivoting over to the audience questions. Our first question here is, again, we have some dynamic founders here. Some of them in the healthcare space. Our first question is from the founder of Halton's Pharmacy in Ethiopia. His question is, how is fintech driving access to healthcare in Africa? And what would you look for in B2B tech-enabled healthcare businesses trying to expand into new African markets?
Fantastic. That's a really great question. We love healthcare and fintech, and we say that we invest in healthcare, we invest in fintech, and we invest in anything in the middle of that. And most of our health techs do have some kind of fintech component. We've invested in a company called LifeStores Healthcare in the pharmacy space. And it started off as B2B software for pharmacies. But then they have an inventory credit product, for example, where pharmacies can get credits or get drugs, manufactured drugs on credit, so that they can have a wider inventory in their pharmacies. So that's like a credit product. For instance, they also have a payments product. And our EMR company that we invested in, Helium Health, again has a payments product. They have a credit product as well. So there's lots of opportunities for healthcare to leverage on fintech. And Anderson Horowitz, which is probably one of the biggest venture funds in the world, has a huge paper out on this right now, the relationship between fintech and health tech. And they have a fintech health tech strategy for America that they've just launched. So we think that health tech and fintech do have a lot of similarities. They're both big markets. They're both regulated markets. They're both quite specialist in terms of the way that investors and founders need a lot of really deep subject matter knowledge to get those businesses right. But they're both capable of really, really massive scale. We think that there's a great relationship there. What are we interested in founders who want to expand? What are we looking for? We're always looking for the same things. We're looking, I call it in my video on due diligence, I call it the jockey, the horse, and the market. So we're interested in the person that's riding the horse. What's the person like? What's their personality like? Are they people that like to learn? Do they have a good team? What's the founding team like? We're looking at the product as well. If it's a software product, for instance, is it buggy? Is it well made? What's the user interface like? Is it easy to use? What's the churn rate? How many customers are they losing? What's the customer acquisition cost? How much does it cost the founder? If you have bad unit economics, so you can find yourself in a situation where, because you've raised capital, you're spending more to get each customer than you are making from the customer. We look for the lifetime value of each customer as well. So that's all about the product. And then we look at the size of the market as well. What markets are you scaling into, and how easy would it be for you to penetrate that market? What strategy are you using for expansion? Are you looking at an organic expansion, or are you looking at an acquisition strategy? And what would that cost the business? And how well have you thought through integrating post-acquisition? How well have you thought through the organic strategy? So those are the kind of things that we look at.
Fantastic. Thank you so much for such a thorough breakdown. Shout out to a couple of the other healthcare founders that we have in here. We have Innovex Global that is in the house. They are dynamic Gambia-based tech-enabled healthcare company that is in here, and a few others. So I like this is very, very, very practical and insightful guidance that you provided not only to our brothers in Ethiopia but also for other health tech entrepreneurs. Next question that I have here is on the is more on the buy side. On the buy side, we have a question from the managing partner of Mansa Capital. Mansa Capital is an investment advisory firm based out of Dallas, Texas, that focuses on investments in the U.S. and sub-Saharan Africa. His question is, do you have thoughts on how newer investors can generate funds or secure committed institutional capital from investments in non-target markets in Africa that have regional scalability? I think you mentioned this a little bit, but if you don't mind kind of elaborating a little bit to the specifics of his question, that'll be great.
So is this from a founder perspective or from an institutional fund perspective? From the founder
from an institutional perspective.
Oh wow. Okay. So the first stop, I was at a meeting yesterday, and most of the fund managers in America actually raise from rich people. So they actually just raise from people's family offices, high net worth individuals. And they get checks for $5 million, $4 million from individuals. And I found that absolutely amazing that you have people in your network that can give you $5 billion and write you a check for a fund, and that's it. I tell you for a fact, you cannot get that money from Dangote. The richest man in Africa, you can't sleep and get $5 billion from him, and he'll just say, okay, go and put it in your funds. I'll see you in 10 years. Very, very few African high net worth individuals will cut you a check for $5 million when you've just met them. But I was hearing stories from fund managers yesterday where, you know, they were getting checks for $4 or $5 million after a single phone call. But the only caveat was that they had to invest in the United States. So the bar is higher for African entrepreneurs because we usually go for institutional capital that has been allocated to Africa, and capital from institutions that have to give it to fund managers because they have a budget and they, you know, have to deploy capital every year to different fund managers. So that takes you into the world of development finance institutions, large impact funds, funds of funds that are focused on Africa. And the bar is a lot higher for raising capital from them. So in order to do that, as a fund manager, you really need to have your documents in order in terms of track record, in terms of the number of exits you've had, in terms of your fund model, both the GP model and the exit model, in terms of all your due diligence procedures, in terms of your tax procedures, domiciliation, every deal that you've ever looked at, they'll want to look at. They want to have a look at all the IMs that you've ever written, how you write your IMs, all the deals that you've looked at, all the deals that you've done. So it's a very thorough due diligence process compared to what a typical American investor that's just approaching a rich guy with lots of money would have. But yeah, I would say the DFI route, the institutional route, is probably more reliable than the rich person route, because a lot of rich people in America really will only invest in funds that are investing in the United States and would be a bit more reluctant to invest real funds in Africa. They might do like some kind of philanthropic contribution, but not really an institutional sort of their main sort of funds that they have for investment in Africa. Diaspora might be an interesting way to tap funds as well, but like I have this presentation actually where I look at immigrants and what an immigrant is likely to earn when they go to the United States. The average Indian immigrant is likely to be earning $140,000 per year. A Nigerian immigrant earns about, I think it's $69,000 per year. Gambian immigrants probably earn about $50,000 a year. So if you're looking for them to write you a $250,000 check, then that's like 5 years of their salary for the average diasporan. So again, that might be a difficult source of capital. But if you know any HNIs in the diaspora that have sort of a heart for Africa and want to invest in Africa, that might be another source of funds as well. But really, your best bet is the big development finance institutions, followed by funds of funds and impact funds, and then maybe a few diaspora investments for investors for perhaps a smaller funds. But the number of people that will even be able to write a minimum of 250K are quite few.
Yeah,
because
no, that's fantastic.
Sacrifice that 250K for 10 years.
100%, 100%. That's fantastic. And this is really coming from someone who's literally on the road raising capital for a fund, right? So this is really, really valuable insights for our buy-siders who are looking to scale up from, I guess, from a angel type backing or syndicate type backing to a formal fund. One of the things that you mentioned there, and I think it's extremely insightful, is the importance of developing a track record and how intensive or intrusive of a process it is for a African fund manager to raise institutional capital from global capital allocators, right? And it's a bar very few clear if you're not the progeny of some big private equity firm, right, that is opening an Africa offshoot or so on and so forth. Given that, right, given that it's very rarefied air, how is it that, and given that, as we know, particularly in the venture side, even on the private equity side to a certain extent, right, a lot of the times the cap table in a particular deal is basically lead investor driven, right? So a lot of the subsequent investors, in other words, piggyback on the diligence that the lead investors have done, right? And so it's almost a case of Mr. Me Too, right? How can, in other words, given that, how can an emerging buy-side investor on the continent who doesn't necessarily have the track record or the institutional balance sheet backing that someone like yourself may have, how is it that they can present themselves to build alliances or co-investing relationships with bigger balance sheet funds like yourself or others?
I think you just have to have a good relationship with the founders. So founders still have some control over what happens in their companies, and they can sort of make allocations for really small checks. So I've seen examples where, 1K checks matter to founders because of the person that's behind that $1,000 check. And obviously, if you're able to bring together, if you're able to find really good deals and you're able to develop like a venture partner relationship with the big firms where you say, okay, I'm going to put in 1K, but I'm going to bring in and crowd in a number of players in the ecosystem that can write bigger checks, then you become a resource for VCs because they're always looking for good quality deal flow. So building relationships. My favorite quote, one of my favorite Bible verses, "Come, let us reason together," because I feel like it speaks to collaboration and it speaks to relationships. And my favorite Harvard Business Review quote is, "The best time to build your network is before you need it, and the best time to keep that network strong is always." So if you have a big network of other VCs, other investors, and you're able to source deal flow that they might not normally see, then you can get away with much smaller checks become a catalyst for them, become a source of information for them. Because one of the biggest problems, if you have $100 million fund or a $200 million fund, is how you're going to get the deals. Like they don't have enough deals. And if you can become somebody that's a trusted resource for deals, then you can get away with writing smaller checks and be on a lot of different cap tables just because of the value that you add to larger funds.
No, I love that. I love that. I love that because a lot of times, what people don't realize is those very, very big, large funds that are blockbuster and are all the trade rags, right? Particularly on the African continent, find it very, very difficult to allocate the funds and invest the funds that they have raised, right? And so, and this is really, really interesting. And it's kind of perverse, particularly if you're looking at it from a founder's perspective, particularly coming from a non-target market, that, you know, you can have basically an abundance of riches or too much capital and not enough places to put it, because a lot of founders on this call are like, give me whatever you can give me, I can put that shit to work, right? But it's actually true. And so for the buy-siders on this call, I love the point that Ola made in terms of figuring out how to make yourself useful in terms of developing relationships with founders, being able to bring opportunities to bigger balance sheet funds, and actually developing a track record and a reputation of someone who knows what they're doing, industry expert, brings high quality deals to the table, and then that relationship will expand from the founders on over to the rest of the buy side community. My next question is from the founder of Ping. Ping is a fintech remittance company, very dynamic, based out of London. Their MVP market has been the Gambia, but they have regional aspirations. Their question to you is, as an African venture capitalist, what are the key operational challenges you encounter when operating in Africa, and how do these challenges influence your investment decision-making process?
Okay, interesting. Really great question again. So we invest into highly regulated industries, particularly financial services. So I think one of the operational challenges is, of course, regulation and maneuvering around that, particularly for new business models that need to be either regulated by the Security Exchange Commission or the central bank, or both. So I think that that's something that we're able to help with from a relationship perspective, to help our founders, surmount some of those regulatory hurdles. I think the second thing is around the business model itself. So the stack that you're going to use for business development. Do you have an offline component? How many of your customers are online? How many of your customers are online all the time? Can they pay for data? Or do you need an offline component for the business, and what does that look like? I think the third one is around expansion. I think one of the key reasons why American startups are so successful is it's literally one of the only markets in the world that you have 300 million people, nearly all above the poverty line, so basically earning $20,000 or more. They have a huge amount of disposable income. They all have internet access. They all spend the same currency, and they all speak the same language. Whereas, in Africa, Africa's entire economy is smaller than California's. Yet there's 54 different countries with different currencies, with different countries.
Yep.
In terms of achieving scale, you have to be very, very strategic around how to achieve scale, what markets to go into. And you really have to work twice as hard. Even India is easier because, again, you have 1.5 billion people.
It's
they
don't
market language, but at least they all spend the same currency, and you're not having to cross any borders to get to a huge amount of people. So I think scale is another thing, and the strategy around scale. So assist our founders with.
Yeah, no, I think that's absolutely fantastic, right? And I think that particularly as founders are kind of looking at their total addressable market and regional expansion, kind of really understanding the macro backdrop of the markets that they're looking to expand into. Right now, the Africa Continental Free Trade Agreement is all the jam. So that's going to bring some increased, over time, increased harmony of regulatory and structural infrastructure, if I say, in place, which will make transversing these 54 African countries, as Dr. Brown mentioned, a little easier. But nonetheless, the regulatory protocols, the tax protocols, all the nitty-gritty from the macro to the micro issues are things that are obviously limiting continental expansion. and it's something that businesses have to be very, very thoughtful of as they basically chart out their Africa expansion plan, because it's very easy and very sexy to say Africa, has a very large population and the rising middle class and all the headline stats and sales points that we hear on Africa, but really kind of breaking that down and understanding what that means and how does it apply to your particular business, given the regulatory constructs and the limitations, the practical limitations of what we have going on. I think is really important. I think that's a really good dovetail and segue to our next question on regulation. Again, this is coming from a healthcare perspective, and this is from the founder of InnoVarks. The question is, how do local regulations in African countries, particularly in key sectors such as healthcare and fintech, influence investor confidence? And what is your perspective on the role of governments in reducing regulations to foster a more open market?
I think the role of government is key for technology. If you think about America, the government is the tech industry's sugar daddy. Google, Amazon, Tesla, Facebook, all of these companies at some point got grants or loans or help from government in some way, shape, or form. And I think that definitely aligning on regulation is a key thing that can help African fintechs and health tech scale. But I think that there's a huge gap between entrepreneurs and government. We don't talk to government. Sorry, can you hear me?
Yes, very well.
Yeah, okay, we don't like government, and governments don't talk to us either. And I think, being able to set up dialogues and entrepreneurs, as soon as their businesses get to a certain scale, really setting aside time for that government relations function will help in the long term. To really achieve alignment in certain spaces, and also from a board perspective as well. Think about having board members that perhaps have some experience with government relations or have worked in government before, because it really does help with that alignment.
Yeah, no, that spot on. Now, from the macro, I'm going to take it to the micro here. I have a wonderful question from, frankly, an inspirational female founder that I had the pleasure of meeting a couple of months ago, and I believe actually won the drill pitch competition. This is from Kumbel Good, or I think she took third place in one of the top finishers. She's the CEO of one of the leading tech companies here in the Gambia, Tables Software Solutions. And her question is, what checks and balances should a startup have in place to be investor ready? Is there a formula that a startup can or should apply when in discussions with investors, especially to avoid under or overvaluating themselves?
Okay, so what things are required when you're raising institutional capital? Like I said, I've written a whole book on this because I've realized that it's something that confuses a lot of people and stops people from raising capital, or people go to market when they're not quite ready to raise capital. And that, once you've gone out to market, you can't, and it's been proven that you're not ready. It's very, very difficult to go back to those same investors and say, oh, now I'm ready. Sorry about the last time. Usually they've moved on, their interest has moved on. So I'm going to try and do something. Don't know if it's going to work. Okay, here we go. Can you see a checklist?
Yes.
Has it worked?
Yes, it has.
I can't see the checklist. So in terms of putting together your data room as a startup raising funding or relatively mature startup, it depends on what stage you are, but those are some of the documents that you need for your Series A. So your fundraising process, communication with employees, your data room, your corporate statements, your financial statements, your market analysis, your cap table, due diligence materials, board and shareholder materials, sales and marketing strategy. And it really depends on where you are. Sort of in the fundraising process or in the trajectory of your company. But definitely one of the things that I find is often missing is just basically the management accounts. Having sort of your P&L, your balance sheet, your cash flow statement for every single month you've been in business. You'd be surprised how many founders simply don't have that. So having audited accounts, for instance, there's a lot of founders that don't have that. And being able to look into the management accounts transparently and seeing where the money is going and making sure that there's a separation between the finances of the owner and the finances of the business. Making sure that you're paying tax, for instance. These are things that investors will ask for. And they'll speak to your customers, they'll speak to your other employees, even at the very early stages. And if the employee is saying, I don't like this, I'm thinking about leaving, I hate it here, then that's, sort of quite a bad sign. So just getting your ducks in a row before the fundraising process. And please follow me on LinkedIn and Twitter, because I'm releasing a book on this. It's a really, really big problem. And I feel like people go to market with just a pitch deck. And when they get into the due diligence process, they just fall into this sort of, really badly put together, and investors notice quite fast that they really weren't ready for the fundraise at all. Getting your ducks in a row before the fundraise is a big deal. Making sure that you're
100%.
ready for a firm and thorough due diligence process.
I love that. And just to kind of put a pin on that particular point, one of the things I love about Ola is she literally is the definition of each one teach one. Every rung, every level that she raises, she creates a lot of collateral to teach other people on the lessons that she's learned. She literally is democratizing the lessons that she's learning, both in business and academically, in real time, which is probably one of the reasons why she has 5-6 published books at the tender age that she is, and has a really, really robust series of lectures on YouTube. We will circulate collateral at the end of this to all the registrants, which will have links to all of the material that she's produced, which will go into a lot of the detail that we have not been able to obviously go into because of time here. But you keep on hearing her reference things that she's produced. We'll create the links. We'll include the links in the takeaways to this. But I definitely advise anybody who has subsequent questions or really kind of wants to get a deep dive into any of the things that we touched upon in this session to go and visit her content. Just cognizant of time here, and we have a ton of questions here. And Ola, you've been fantastic. If I can draw down on my relation to equity a little bit here, just kind of steal probably about like 5 minutes from you here for a couple more questions, because they're so good and they're coming in from the audience fast and furious. I'd really appreciate it. Are we good?
Yep.
We're good, Ola? For 5 minutes, five more minutes for some final questions from the audience? Fantastic, fantastic, great. This one is coming, I love geographical diversity. This is coming from a founder out of Kenya. This is from Maurice Hickman. He's the founder of Pathfinder Maven. It's a market entry advisory and growth consultancy firm. His question is, how can you articulate, can you articulate how you view or manage expectations for African startups, growth models, and how that can be better communicated to VCs that are not used to investing in Africa. Did you get that? Or do I need to repeat that? I kind of messed that up a little bit, but hopefully you understood what I said.
Sorry, could you come again with the question?
Yeah, sure. So the question here is, can you articulate how you view or manage the expectations of African startups and their growth models, and articulating those growth models to Silicon Valley investors or investors that are not typically used to investing in African startups or the African landscape?
Okay, so yeah, I understand that. So a lot of the people that invest in Silicon Valley, actually probably I hear it's between 60 and 70% don't invest outside California. I was at a conference yesterday here in the Bay Area, and a lot of the people who are Americans, who have lived in America all their lives, could not identify Indiana on a map. So it's not just an Africa problem. There were some people that were saying that they don't invest in Canada. And a lot of investors here don't invest outside the Bay Area at all. So they don't invest in Kentucky. They don't invest in Mississippi. They don't even know where those places are. They invest in New York, Miami, Boston. That's their idea of America. So explaining to them about African startups is a real job. In fact, some of the VCs that have invested in Africa, we realized that the money was from their R&D budget or their marketing budget, not from the actual fund. So explaining the opportunity for growth is explaining why Africa. And I think the first thing that I point out is that a lot of investors missed the boat when we had the exponential growth experienced in China, in Vietnam, in Singapore. And it was the same story. We didn't understand these places, so we weren't going to invest. Or we're not going to invest. But actually, I think that a lot of investors regretted, missing that last opportunity when the Asian tigers were really coming of age. And Africa is kind of the final frontier for that kind of growth. So after sort of Africa reaches that inflection point, you will not see that kind of growth ever again in the world. So this is the last sort of possibility. So there's that story. There's another story around demographics. Africa is also the youngest continent in the world. Internet access, mobile phone access is exponentially increasing. And that means that technology services should be scaling exponentially as well. Consumer services should be scaling exponentially. It's going to be one of the largest or fastest growing, at least, consumer markets in the world, just purely because it's the only place that is still growing in terms of growth rates, in terms of population growth rates. Europe is declining. Japan is declining even more rapidly. These places have aging populations. The average ages in some American states are 60, 65. In America, in Africa, the average age is still 18, 19 across most countries. So it's the only place where you can find fast-growing young population. These demographics usually are a good indicator of exponential growth. We also look at the venture capital per capita. So in countries like Singapore, for instance, you see that for each citizen, you need about $1,000 of venture capital investment. And they've produced maybe 5 to 6 unicorns. In Africa, there's $3 of VC per citizen, or less in some countries, so $1 to $3 per citizen. And we've still produced about the same number of unicorns, which means that there's a huge opportunity there. Imagine if we got that amount to $100 or $200 or $300, how much economic growth we could produce, how much value we could produce, how many unicorns we could produce, how much in terms of returns to investors that we could produce. So even in a relatively, or should I say relatively, hugely underinvested market, I mean, Africa is 13 to 15% of the population, only 1% of the world's investment. So there's an arbitrage opportunity even there. So those are the stories that I tell. Number one, the China story and how so many people missed out, and the people that went into China early and took that risk, got rewarded greatly. the positive demographics, young population, exponentially growing population, the only population that is still growing as opposed to shrinking, the only population or the only place in the world where people are still having babies. And of course, this idea of a comparative and competitive advantage in technology, where you're seeing, despite huge amounts of underinvestments, highly valuable companies coming out of the continent.
No, it's fantastic. And I think it basically dovetails to the point that you made earlier in the beginning of the conversation in terms of that point of alignment, right? You want to make sure that you are aligning yourselves with investors that understand the vision, right? It's difficult enough trying to explain your business to an investor, let alone trying to explain the business plus the macro backdrop, et cetera, right? Which is why folks like Ola and other buy-side investors in the African ecosystem so valuable, and why we need more of them, which is why I'm very happy to see a lot of buy-siders and a high net worth or what I would say is actualized investors that are looking to have greater impacts, right? Investing in the entrepreneurial ecosystem, because you already get the why. You get the Africa story, right? And now you can just focus in on the business. And I think, which is why we champion folks like Ola and Pamusa at Mansa Capital and folks like Malik as well as the various angel investors and buy-siders on this call, is because it's really, really important, right? They'll get the story eventually, but you really want to make sure that you're aligning with your investors. Just the final question here. We can carry this thing all day, but I know you're in the middle of a pitch, and I've already drawn down on my relation equity to the point of discomfort here. This comes from, I will let this founder be anonymous, but this is probably my favorite question of the day, which is why I kept it to last. In the marital home, they say happy wife, happy life, right? But and as men, as women, as young folks, we're led to, and we aspirationally would love to marry our partner, right? And in some businesses, that is not just a partner in the metaphysical sense, right? In the relational sense, it's actually your business partner, right? So as an investor, right, how do you do you have a view on husband-wife co-founding teams or management teams, if at all? I'll stop there and let you expand to the point of comfort.
So I've invested in a husband-wife team. One of the most successful companies in our portfolio. The company is called MDAS, a diagnostics company, the third largest, expanded from nothing, 2 students at MIT to the third largest and fastest growing diagnostics network in Nigeria. And they're married. So I don't think that that's a red flag. I think there's plenty of companies that do, but I think that it's about the discipline that they have as founders and being able to understand their sort of personal commitment to each other and also their commitment to the business. And these founders have done that excellently well. And I definitely don't think that it's a red flag. There's another question that comes in with regards to relationships and business, which is that the entrepreneurial journey itself takes a lot out of you. It takes a lot of time. It takes a lot of energy. It takes a lot of focus. And balancing that, I guess, with a marriage or with a relationship and the complexities of that, taking on that extremely stressful journey with a partner, requires a lot of communication and a lot of sort of boundaries and a lot of emotional intelligence. But I've invested before and will do again because couples can be extremely high performing teams, and I definitely don't think
I love it. I love it. So anecdotal evidence suggests outperforming husband-wife teams outperform anecdotally. Limited sample size, we get it. But taking it out of the joke and just kind of like for those companies that may actually be husband-wife founded teams, right? As an investor, what advice would you have for said teams? Like, let's put the therapy side of things, aside, from a risk management perspective, right? As a risk manager, what are the things that you'd want to see that are in place that a husband-wife team would like to present in order to give you comfort? And is that any different from any other co-founder agreements or situations that you may have?
At all, it's the same. I don't look for anything different than a normal co-founder agreement. And if you have a partnership agreement, or if you have in your shareholder agreements, just the normal things. I'm not looking for anything different just because they're a married couple. I'm looking for the same things that I would find in any shareholder agreement.
Fantastic. With that, I thank you. You have been fantastic. Thank you so much for joining us. I found that extremely enlightening, and after knowing you for 20 plus years, you still find ways to surprise me and impress me. I'm very, very grateful for your time. I'm super, super proud of you and a big fan, and will continue to root you on. By the veracity and like the cadence of the questions coming in, I believe the audience enjoyed it as well. To those of you who I did not get to answer your questions, forgive me. As I said, some of the questions that you answered will be that you asked. The answers to those questions are in the content that she has produced, and we will circulate to the team. But with that, I recognize we went over time here. I hope it was informative. Apologies for the time overages. And good luck to you in in your respective journeys. With that, I'll turn it over to Malik.
Great, I learned so much, and this was really incredible. So thank you both, Tedla and Dr. Brown. It's amazing. So looking forward to many more in the future. And for everybody that stayed on throughout the conversation, thanks for your time. Here are ways you can reach out if you want to connect with us. Looking forward to. I've also linked Dr. Brown's Twitter in the comments there if you want to go ahead and follow her. She also sent in her YouTube channel there. But everybody that has registered, will send you an email with the recording and all the other contact details for us. So thank you. I have nothing further to add other than just grateful and thankful for you all. Dr. Brown, I know it took more than your time, but I really, really, really appreciate it. This was really educational for me. I learned a lot, and actually has me thinking a lot about investing in Africa. So yeah,
thank you so much. I thoroughly enjoyed it. Thank you. You've been an amazing host. Thank you, Tedla. Thank you, Malik.
All right. Thanks, guys.